Welcome to the Financial Advisors Want to Know podcast, sponsored by Dominion Enterprise Services. I'm Catherine Tindall, CPA and founder of Dominion. We're a tax and accounting firm focused exclusively on serving advisors for their own tax planning and filing needs as business owners. At Dominion, we work alongside advisory firm owners to bring proactive strategy, clarity, and confidence to their tax planning so they can focus on growing their firms. The focus of this show is to cover different areas that I've experienced as a tax planner, working with advisor clients in their lives, building their practices. So let's get started. Hi, everyone. On today's episode, we have a very special guest with us, Nicole Frey. She is the Director of Team Solutions at Succession Resource Group, leading SRG's entity and merger services. She and her team help financial advisors with entity formations, restructuring, and mergers. And today's episode, we're going to be talking a lot about entities and advisors and how running your ops and running your entities and the legal background for how you have things structured is so critical. So thanks for coming on the show today, Nicole.
Thank you so much for having me. It's such a great show. I'm so excited to be here.
Yeah, it's such a good topic because I think of the things that advisors ask me about, questions that I get, so much of it revolves around entity structure. And in a lot of the conversations that I have with advisors specifically, they have, serious concerns, and depending on however they're structured, like if they're independent or if they're with a broker dealer, so many things will change around what we do with the entities. And then once we get into succession planning, it's just, there's so many unknowns, I think, for people. Mm-hmm. And a lot of the questions that I end up getting usually initially with people who are interested in joining us as clients, a lot of it revolves around understanding, a lot of fundamental concepts around entity structuring and what the different entities achieve. So I think it'll be a great conversation. In your experiences, working with advisors who, don't have a strong background in what goes on with formal entity structures, what's some basic background, say you're talking to an advisor who's just, they've been a 1099, maybe they're forming an RIA or they're purchasing into an existing one. What's some of the background information that, from your perspective, they should be aware of when it comes to entities and what they should be thinking about?
Mm-hmm. So that's a great question. And that's always what we start with when we start a project or a program with an advisor who comes to us and we help them with their entity setup, is actually thinking about what it is they want to accomplish with their business. So we talk about not just the short-term objectives, it's definitely important to also consider any long-term goals. Because as you know, on the tax side, Catherine, the entities come with certain taxation, certain restrictions, certain flexibilities. So we always start there, determining what it is that they're trying to accomplish, how you're currently set up. Do you have a broker-dealer affiliation? Do you want to form an RA, or do you want to affiliate with an RA as an IAR? Because that all determines how revenue flows once it is earned, what they can do with it, what are some of the risk factors. So that's where we start out, is talking about their goals. And with that comes things like mergers and acquisitions. Mm-hmm. Do you plan on sharing equity at some point, whether that's with an internal team member or, we talk a lot about the trends in the industry like consolidation. There are also a lot of recruiting efforts by firms nowadays because we're dealing with an aging industry. Unfortunately, there are more advisors exiting than they're entering the space. So with that always comes up the equity conversation. And every time you deal with equity, the next question should be, what type of entity do I need to accomplish all of this? So that's usually the conversation that we have. I don't know what you see on your end, but I can assume it's similar.
Yeah, I always tell people, when we're getting into specific advice around entity structuring, I always have to start from the perspective of, okay, what are the actual operational objectives you're trying to achieve? Mm-hmm. Like, pretend none of this legal, tax, and accounting stuff exists. Like, from an operations perspective, how much do you want to be getting paid every year? When do you want to be exiting the business? Is this other person going to have an ownership stake with you? Are they going to be an owner with you? Are you just going to have employees and then eventually you're going to wholesale this thing? how much clarity do you have around that? Because for a lot of advisors, they're like, I don't, I'm going to be doing this for the next X number of years. I don't know how I'm going to exit. I'm not really, I don't really care about that at this point. And so just getting whatever clarity that we can on what they do know and what they do want, and then just backing into, okay, what's going to be the simplest way to get this done that's going to support the goals that they're aware of. And then also, just from experience, not wanting to shoot them in the foot for the future when they go to exit, if they're, depending on what kind of setup they're going to have. Because if I'm talking to somebody where they're, I'm going to try to be acquiring practices like every other year and just grow this into a monster, that's going to be a very different conversation than,
Right.
A lot of the advisors where they're, I'm going to have a lifestyle practice. I want to get it to $1 million a year. I'm going to have like 2 juniors underneath me. I'm going to train them up over time. Eventually they're going to be purchasing out tranches for me. Like, that's a very different situation. And so I always like to get that, that same sense as well. It's just like, okay, what are you going for? And then what's the simplest way for us to get there? And then I think a lot of the complexity that I encounter really, when you change from the bucket of being a single owner operation to a multi-owner operation, or that there's multiple equity stakes going on, that's where I find most of the complexity comes in with the entity structuring, because a lot of the rules and things that we have to follow from the tax perspective are coming down to how do you want to be compensating each other, and how do you want to be accounting for that, and where is revenue showing up, where are expenses showing up, and then where is it all landing within tax returns between, entities, personal Schedule C filings, like do you have a company, a separate entity that owns the building, like what other things, are part of the network. So it's a lot of it though just drives from what are you operationally trying to achieve, and then we back into the simplest structure. What are some common entity setups that you see, and some of those decision pivot points when it comes to the choices between the different entities from your perspective? And I can speak from the tax perspective as well, but from an operation, strategic level, what are some of those differences?
Yeah. So I think you already mentioned one of those, and that is how do we want to get compensated? And you mentioned practices that might want to grow internally. So this is where the objective is to raise the successor owners internally through their employee ranks. The employees oftentimes are very much interested in still maintaining W-2 compensation and their benefits. So obviously that is only something we can accomplish if there is an S Corp in the mix. So it's an S Corporation allows owners to get a W-2 salary and take profits out as K-1 distributions. That's usually what I see is, the S Corp comes in to play either if employees want to maintain that W-2 as they then become owners, and then obviously, the tax savings for certain firms cannot be ignored on the profit side. So if an owner really wants to prioritize certain tax savings, the S Corporation might be something they want to look at. But I have to be honest, the S Corp has lost an interest in recent years because it comes with a lot of restrictions. And these restrictions are not really helpful if advisors want to engage in some of those industry trends like mergers or easily, adding other partners. So the way this is done is a lot of times in this industry, advisors find a peer who is a good fit. They envision that they will team up. And the goal is that they contribute their books of business, their goodwill to an entity so that they can then own that together through the entity structure. That way they can stop tracking mine versus yours, and they can focus on how do we grow this business together. They can create teams and departments, and so they start focusing on that more versus their individual books of business. To contribute a book in exchange for ownership in the firm is a lot easier when you have, for example, an LLC taxed as a partnership. We don't have to worry about tax implications here. It can be easily done with S corporations. That can be a whole lot more difficult, as you've probably seen. It's doable, but now we're talking about statutory mergers. And every time I mention that, I can see advisors just go, oh my gosh, what did I get into?
Yeah.
So the LLC partnership has really gained in popularity. It allows people to set up different ownership classes, which is great for equity sharing purposes. People who buy an interest in an LLC can amortize that purchase over 15 years, so they get a write-off. So all that is not possible in the S corporation. That's just easily done in a partnership. So that's the most popular form that we set up nowadays for people who still want to leverage the tax savings that the S Corp provides, or have that opportunity to participate in a 401k, for example. We create something a little more complex. It's an LLC that is owned by individually owned S corporations. So it gives advisors the best of both worlds. They get the flexibility on the main entity level. That's their operating entity, which is an LLC taxed as a partnership. And then they own their interest through an S corporation. So any profits that flow out to them go to the S corp first, so they get some tax savings there. Obviously within reason, so we do have to talk about that too, so it doesn't raise any red flags.
Yeah, and it's a common structure. I always kind of work through this with advisors with, we start off with the thinking about doing the S corp, but then the issues with the compensation, if they want to have the ability to do unequal distributions, like that's going to break your S corporation. If you know that in future you're going to want to have like different kinds of equity involved in the practice, like some profits interests or things like that, you're going to run into issues there too. So it is really common that we'll end up, if they need more flexibility, recommending a structure like you're saying, where you basically have the partnership on the top, all the revenue comes into that partnership, or as much of the revenue that you can get into that partnership. People who have broker-dealer relationships, that's a whole other thing. But, getting as much revenue as you can up into that partnership level, all the operating expenses come out at that partnership level, and then the individual owners get a K1 to their S corps, and then the S corps have their own set. And what I really like from the tax planning perspective is you're able to, the different owners can have more control over tax planning elements as well. So like if one advisor has, they want to take a discretionary trip that is deductible, it's a business expense, but the other partners don't necessarily want to be footing the bill for that, or it's not really at the partnership level they want to pick up that expense. This is more true for practices where maybe you've got, grouped things such as admin and overhead and software and branding and, insurance policies and things like maybe rent space. But then really the individual owners are running their separate books, like they've got their own client bases. Having that structure can be helpful because there's a lot of things that we want to take advantage of as tax deductions, like if they have a business use vehicle, if they've got travel that the partnership doesn't want to pay for. Another big one has to do with pass-through entity tax payments, like if they want to be making state payments at their entity level, so they're getting around that limitation. It's much easier to do that at the S corp level than having to do it overall at the partnership level. And then I think the biggest benefit, at least I see, is that if you want more flexibility in the compensation structures of, if you want to have some things tied into performance, it's easier to achieve that in a partnership with, unequal allocations usage. And then you can make it a lot cleaner that way while still maintaining the self-employment tax savings. Because, for people that are just purely in a partnership, the main tax benefit is they'll still be able to do those pass-through entity tax payments at the partnership level. So what that means for people who aren't familiar with it is you can, depending on what state jurisdiction that you're in, if you have limitations around your state and local tax deduction, because, for those earning over, I think it's like 500,000 this year, the limit is only 10,000. If you want to be able to have those payments be deductible, you can do them at the entity level. You can do that through partnerships usually. You can do it through S corps as well. And so that ends up being a big tax savings for a lot of people, especially in high cost states. But for those that are in just a partnership structure, basically all the K1 income that flows through to you is going to be subject to self-employment taxes. So depending on where your income is, that may or may not be a huge issue if the practice isn't that large. But as the practice continues to grow, that will become an issue. So like I was doing a case recently for a couple of advisors where having them in the structure where they've got the partnership on the top and then the two S corps underneath was going to collectively save them $80,000 in taxes every year. Like every year, just by having those different rungs to be able to do those two techniques. So it can make a really big difference. And I think from a complexity level standpoint, you know, there's administrative cost to it by having those multiple levels. But when you look at, you know, when we do the modeling for firms that are thinking about this, or, you know, advisors who are thinking about becoming a partnership for the first time and merging, you know, they're like two solo advisors and they want to do something bigger together. Usually just calculating out, like, is the juice worth the squeeze? A lot of times it is, you know, especially if growth is the goal. But I guess for, you know, simpler, when you have solo owners or solo setups, I think another common instance that I encounter is, say you've got an advisor who's got an existing practice and they want to start bringing in junior advisors who are W-2, but start granting them equity. What are some of the, you know, some of the considerations in those kinds of setups where it's, you know, it's definitely a first generation and a second generation, very unequal relationship, but trying to equalize it over time for exit? What's some of the things they should be thinking about?
Catherine here. Just wanted to say thanks for tuning into the show and hope you've been enjoying it. Since we're all at the mercy of social media algorithms, if you wouldn't mind rating the podcast on whatever platform that you listen to, I'd really appreciate it. And also, if you're looking to stay in the loop on current tax updates, what the firm is working on, and just the things that I think you as a firm owner need to be aware of when it comes to the world of tax, you can sign up for our newsletter using the link below. I only send out editions when we have really useful things to share or things that I think are important to have your attention and energy on. So let's get back to the show, and thanks again for being a listener.
So obviously, you know, if it is an employee getting equity, they have to consider the tax impact. Usually equity grants are treated as taxable income to these employees. So that's usually something that surprises people when they come to us. But that is something that they have to be aware of, that it's considered compensation. There are some other models or solutions so that you can reduce that tax impact. For example, you can make it subject to vesting so you can spread it out over time, or you couple that equity grant with a bonus. You know, you might think about a dollar amount that they should receive in a given year, and instead of just giving all of that in form of equity, you would give them a bonus for a particular portion so they can cover the tax bill. So that's one. The compensation, as I mentioned. So if the advisor doesn't operate an S corporation, but is an LLC, the new partner then would no longer be eligible for W-2 compensation. Instead, everything would be paid as K-1 income. To your earlier point, they can still make sure that that compensation kind of mimics what they had before. They can get a guaranteed payment. They can get special allocations for special performance, for example, and then profits typically based on ownership percentage. So they still have the same tools. It's just the tax treatment is different, and they have to be aware of that and how that might impact any benefits that the firm might offer. On the more, you know, managerial side, how to run the firm, I think owners should really look at their governance documents and make sure that they are tailored towards that new scenario. So what I'm referring to are voting requirements. It is very common that certain operating agreements require unanimous consent for certain decisions. So here it's something you can customize. You know, you might not want to give a 1 or 2% owner that much voting power over something that might be crucial for your business in order to continue successfully. So we always take a lot of time with our clients to work through that, making sure those voting requirements are tailored to their needs. And then buy sell provisions, you know, now you have a partner thinking about the unfortunate events too. Partnership doesn't work out, or even death and disability, making sure you have the right terms in place and protections. What if someone leaves and takes clients? How are you made whole for that loss? So those are all the things that they should consider as they share equity with team members, or even bringing an outside person in. So we'll go through the same process at that point.
Yeah, and I've seen cases on my side where people didn't take the time to really go through their operating agreements aggressively before trying to jump into operating an entity together, and it ended up not working out very well, and they kind of had to blow things up. But so I think it's one of those things where, like I mentioned earlier in the show, when you're moving from 100% equity in one person, it's just much more flexible and much more simple what we need to do, versus once you've got even 1% to one other person, the level of complexity that gets introduced with like your operating agreement, how the income taxes are going to work, how you have to structure things, how buttoned up you need to be from this perspective. It's a big complexity ceiling that you go through with just that one change. And so I guess, what are some maybe industry specific gotchas or best practices that you've seen, firms maybe not be aware of when going through this process of making entity changes and selection choices?
Well, you mentioned one of them earlier, and that pertains to advisors who are affiliated with a broker-dealer, or I even added in IARs who don't have their own RA, they're affiliated with an RA, and now these advisors receive their revenue paid to their social security number, but they want to get that into an entity. This is always where that famous tax court case comes up with Ryan Fleischer, the LPL advisor.
Yeah.
And we definitely need to make sure that they're all buttoned up. As a business owner, you should and can have an entity. So this should not stop you from putting an entity together, but it needs to be done with care. We need to make sure there's a contractual basis for how revenue comes over. We always distinguish between a single owner entity versus multi-owner. The scenarios are different, so we adjust our solutions based on that. For example, whether you have an LLC versus an S corp plays a role. So it's how that revenue flows into the entity that needs to be done carefully. And then if you do have an S corp, and this is probably where you give advice to clients, if their salary is too low, that's the first red flag. Making sure that their salary is reasonable based on the role they have. I always look at the income too. If the income, the total take home is $1 million and then their salary is $100,000, I'm not sure if that will pass in case of an audit. Usually we want to see a little bit more there to balance that out, the profits versus the salary.
Yeah, and maybe to give some feedback on that point too, because it's an area that we always look at for people. So like when the IRS looks at this, basically there's a number of methodologies that you can use for determining reasonable compensation. The long and short of it is like we use a software program that goes through that process and picks out the best one. But it's one of those areas where I see advisors just kind of like pick a number. And that's really not the process that you should have with it, because it should be a combination of, okay, we're going to have an IRS baseline of if you go below this number, you're going to have a problem. But then we look at, well, where are you in your taxable income life right now? Because I have some advisors where they can be in the QBI phase out ranges, or they're in another like specific little zone of earning where, if we just bump up your W-2, it's actually going to fix a lot of other things in your tax situation. Or, you want to max out your 401k contributions. We actually need to pay you more in order to be able to do that. So it's one of those things where it's a balancing act when you pick whatever you're going to do for reasonable compensation. But I think my usual piece of advice to people is, it's got to be a process that goes through, and you start with that baseline and then you make a decision after that if you're going to go up and go higher. One of the things that I've also found too with the S corps is that when you've got a multi-owner S corp and say you need to do compensation based on performance, really your only option to be able to equalize that is going to happen through the W-2s, because any distributions that you get. So to just give an example, like if I have a firm where they've got a 90% owner and a 10% owner and they're an S corp, every dollar that comes out as a distribution, the 90% owner gets 90 cents, the 10% owner gets 10 cents. And so if we need to do equalizations in comp, like how much they get paid overall, we're going to have to use the W-2s, which can be less efficient for Social Security taxes, basically, because you're now going to get subject to more payroll taxes in order to do those adjustments. But it's a super common issue that I encounter, and something that's just a routine planning thing we have to look at every year.
Yeah.
Any other specifics when it comes to maybe some of the partnership setups or partnership considerations for industry specific gotchas?
Maybe for the partnership, obviously, we need to talk about compensation and how that's split up. Sometimes people still like to track their profits with their contribution. So it is more figuring out what everyone produced, applying any expenses, however they want to allocate that. So that would be an option. What we call ensemble firms, they look at it as this is one pool of revenue, one pool of expenses. We split this up, but they should also think about then compensation. So you brought this up too, that compensation is important to discuss. It shouldn't just always track with client related roles. There are also managerial roles that have to be performed. I get that conversation a lot. That is, hey, if I bring in more business, is my ownership adjusted over time? And the answer for ensemble practices is typically, well, that's not the intent. However, you should definitely be compensated if you make a huge contribution to the business. So that's something that owners often kind of put on the back burner. They put nice compensation plans in place for their employees, but then for themselves, it is pretty basic. Even though it is so important to reward the partners too for their specific roles and create certain incentives. We have a team that works on that with partners, but for the most part, it's always their employees. So it's not a whole lot of work with partners just because they don't look at it that way. But it is definitely important. We worked with some large teams where that resulted in a little bit of agony amongst the partners because some people just put in so much time and effort and on the managerial side, but didn't get the reward like others. So, yeah.
Yeah, I've seen that be an issue too, because it's kind of unseen effort on both sides. Mm-hmm. Yeah, it can be hard for them to realize like, oh, the reason why you were able to bring in all this revenue is because you weren't having to deal with all this administrative stuff. But then at the same time, for the administrative people, it's like, well, this is a really necessary and important task, but it is kind of like an employee task. And so should you actually be getting improved compensation for basically fulfilling an employee role? So it's like that headbutt happens. And so that's why, like I mentioned earlier, it's so important when you're going through those, when you're initially doing formations. This is more for like the newer partnerships. Like you really need to get that stuff out in the open and be on the same page and have alignment with how compensation is going to work, and then how compensation is going to work as the organization grows, and what's going to be performance based, what's just going to be, you're a 30% owner, you get 30%. Like at what level, where on the sliding scale are you going to do that? And it's so idiosyncratic to the organization and its goals. Like people will oftentimes they'll ask me like, well, what should we do? And I'm like, it's your business. Like I can tell you how it's going to flow on the taxes and what's more or less efficient for ultimately how we report everything. But when it comes down to how you want to make these selections, it's much more of a strategic move, and it's just so specific to the particular individuals that are involved and the particular organization. So I guess before we sign off, any last pieces of advice or things that you would want to, for those listening to the show, would urge people to be, we're recording this early in the year in 2026, but things that maybe are, routine things that just firms should be thinking about when it comes to some of these entity issues, or, how frequently they should be addressing some of these things?
So for advisors who already have entities in place, I would recommend taking a look at how they're currently set up. Are their documents up to date? Who is maintaining the entity for them? Kind of revisiting too, what do we have in mind in terms of business goals going forward? Talking with their CPA or calling us, is my entity supporting those business goals? If not, there are ways of restructuring that. So not everything is set in stone. We can definitely find solutions. And for advisors who still operate as sole proprietors, I would definitely reach out and get an entity set up. First of all, you should not have that personal liability exposure. Also, you should consider, your business is starting to evolve probably beyond just a book of business. It's becoming a true firm. Having a more structure for your organization just helps you be more organized and prepared. We see it all the time. People want to acquire a book of business and then they don't have their ducks in a row. And then the lender says, well, you need to fix all of this. And then they lose the opportunity to buy the book because it takes too long. So it's really good to do proper maintenance, look at it. I invite CPAs all the time. This is how you and I met, just because it is so important to really talk with your CPA through what are the pros and cons of this structure, what could I do better, and then pivot if needed. That's my advice. Really making sure you take an active approach with entities. Don't leave that up to just your CPA or your lawyer. It is something that advisors should actively participate in.
Yeah. And I think, it's one of those things where I'll see people put this on the back burner. And then I have to have this conversation way more frequently than I like to, which is, oh, well, you should have been set up like this and we can fix it. But, you basically have been wasting, this amount of tax dollars every year. Like I had one person earlier last year where basically he had been wasting like $40,000 a year on something that's like a very easy adjustment. And it's just because it wasn't getting looked at. So it can be a really, if you haven't done this work and haven't done this work with a tax advisor, it can just be like, oh, automatically, like we just made another 40 grand this year just by shifting around, some of these different components that interact with each other. It's like very little lift on your part to fix some of that.
Right.
So it's definitely one of those things where, if you haven't done it or you're anticipating changes that are going to be happening in your org, it's good to know ahead of time what you're going to need to do as well. Like a lot of advisors, will approach me where it's, oh, I'm trying to do this succession plan and like the deal's on the table, in a month. And I'm like, that's just not enough time for us to, sort a lot of this stuff out, versus the ones that'll say, okay, I'm going to be operating this for like 2 years and then I'm going to cut in this junior probably for this percentage amount. I want to start thinking about what this is going to look like now. And with those conversations, there's a lot more that we can do with that, a lot more creativity that we can have too with, just really making sure that the advisor's getting the outcome that they want. A lot of times if they've kind of rushed through the process of doing an acquisition or some, equity changes, there can be things that they overlooked or, significant inefficiencies or problems in it just because, they didn't have tax modeling done before they decided to, get into this deal or whatever it is. But I think always, it's one of those things like once you've got the structure good and then you're not making any changes, you can operate it for a good amount of time as long as there's some kind of routine making sure that it's still the right situation for you. But if you've never gone through that process before, you could be leaving a lot of money on the table, a lot of liability on the table, and just, not having the org be at the level that it should be at for supporting you. So for those interested in learning more about what you and your team do, Nicole, could you tell us a little bit more about Succession Resource Group and how people can get in touch with you?
Absolutely. You can find us through our website, of course, successionresource.com. Our firm is a consulting firm. We mainly work with financial services professionals and have done so for many years now. Our services include valuations. So this is usually a good way for an advisor to determine whether or not there are certain weaknesses or pain points in their practice that oftentimes they can easily fix, and it will increase their value quite a bit. So that would be a good way to at least assess where your business is at this time. We also help establish compensation plans. Earlier we talked about flow of revenue, and with that always comes in the compensation of people. Can we pay them a percentage of production? The industry is slowly moving away from that to W-2 and bonus comp, but that means we need to create good comp plans for them that have similar incentives. We set up equity sharing plans. We help with the buying and selling of practices, and death and disability plans too, which is always interesting because this is something advisors always tell their clients to do, and then they often don't have a plan in place themselves. So we can help with that. And my team in particular, we help with entity formations, restructurings, and mergers. So we get a little geeky on that side with all the entity stuff, but we love it. And I think our advisors always get a lot of education through our programs.
Yeah, that's wonderful. Well, thank you so much for coming on the show today, Nicole. I really appreciate it.
Thanks so much for having me.
Thanks for listening to the Financial Advisors Want to Know podcast, again, sponsored by Dominion Enterprise Services. If you found this episode valuable, I would love to personally hear from you. Connect with me on LinkedIn and send me a message. I'm always interested in your feedback, future episode ideas, or questions you'd like to see covered in a future episode of the show. And be sure to subscribe to our monthly tax update newsletter, where we share timely tax insights and planning considerations specifically crafted for advisory firm owners and what we share to our own clients. We'll see you next time.